So, Mr. Frost, welcome back. Happy New Year. This is
Happy
our
New Year to
very,
you, man.
appreciate you, very
You
first
too.
housing market update of 2023. And let's jump right into it. Why don't you give us a quick update on mortgage rates, what's been happening, where the markets are at, and then we'll get into some specifics.
Cool. Well, thanks. Well, Happy New Year to everybody that tunes in for these riveting updates. It was the beginning of the year has been it's actually been amazing for rates. So we had and we talked about this before. Like at the end of the year last year, I had predicted. I said I think rates are going to be like 5.75 going into the new year, and I was totally wrong. I mean, rates at the end of the year there's a lot of like kind of like I think like global like right sizing with changing some of their bond structures and things like that in Japan, and then the government with that massive omnibus spending package. And a lot of those things kind of scared some bond investors. We had some bond auctions that didn't do very well. Then we also have massive investment funds kind of changing their portfolios and strategizing for the new year and tax advantages and things like that. So we just saw rates go up like 6.75 at the end of the year. It's important to admit when we're wrong. And I only am willing to admit that because going into this year, we've had a great start for rates. So we had, last week we had a big employment number. And then we had, which you can see, that was the one, if you go back to the left just a little bit, that big one. So that was our employment report that came out last week. So one of the things that you and I talk about is inflation, right? Like I talk more about inflation than I talk about chocolate chip cookies, which is sad. But there is the big thing right now that the Fed is saying is driving inflation is the labor market. The labor market is so strong. And I posted a video the other day about there's 1.7 job openings for every employee, which is amazing news if you work for somebody, because this is the time that you can set up the rest of your life. If you're not happy working somewhere, there's never been a better time to go somewhere else. So nobody can complain about their job. But the problem with that is that in order to keep people, employers are paying more money, right? So your wage growth is still growing almost in line with inflation. And then on top of the wage growth growing, you have hours worked were increasing. Well, this jobs report came out, and there's two numbers they look at. They look at the BLS, which, and again, this doesn't matter, right? So there's like the headline number, which is what the government reports. We're looking for 200,000 jobs, and they reported 223,000 jobs. So it's like, oh man, the job market is still growing. Like this is going to be terrible for inflation. And there's another section of the report where they survey like 25 million job openings and things like that. And they said 717,000 new jobs were created, but 680,000 of those jobs were part-time jobs and second jobs. And on top of that, hours worked decreased and wage growth didn't really grow. Like it was very, very minor. So once you actually dug into the nitty gritty of it, then that's why we saw that big green, we call them candles on that chart. We saw that big green gain. And that almost gave us back everything we lost at the end of the year. Because hey, this jobs market is shaky at best. Like these are people that are getting second jobs because they need the money, like that because they're trying to fight inflation, or they're not getting the hours that they had before. So we had that last week, and then yesterday was our big CPI number. So the CPI number, it came back in line, right? It didn't knock anybody's socks off. It actually surprised us because one of the components of that report came in very high. It was still very high, which is shelter costs. But either way, the CPI index came in. It was down like 0.6% year over year, which we look at that chart a lot. And that is exactly what we wanted. We're still in the very high parts of last year, and now we're coming down compared to that, which is very good for rates. So as the markets continued to digest that throughout the day, we saw rates continuing to improve, and we finally. It's like last night I was on the computer at like 9:30 at night, making sure the markets were all set, and locked in some loans below 6%. So we were at like 5.99. I did a 5.89. I had a 15-year at like 5.375. So lots of stuff happening back in the fives, depending on like that price strategy. So seen a lot of gains in rates and a lot of positive news in that department to start the year.
That's great news, and, going back for a second, the thing that you said about your mortgage rate prediction, we'll probably find ourselves in the mid fives. I'm hoping by spring is kind of where I see things. And I guess the biggest point is rates didn't go to 10, right? They didn't go to 10. They didn't go to 12. They didn't go to 13%. Like a lot of these people were suggesting that they would. And
They
so
didn't go to 8.
they didn't go to 8.
There's no, on a conventional normal day, there is no 8%.
Yeah. So, I mean, overall, what's going to happen is as we get into home buying season, as we get into the spring months here in the next 45, 60 days, I mean, I just think that there's good news ahead. I think that the worst is behind us. What do you think about that? Like, do you agree with that, or do you see that differently?
I agree with it 100%. And we have shown, you and I have shown that, like, the relationship to inflation and mortgage rates 100 times. And I've explained that 100 times, and I'll do it again in 30 seconds to tell everybody. But the way this works is that inflation is when goods cost more, right? When your same $20 got your grocery list in the past, well, now it costs $29 to get the same amount of groceries, right? That's inflation. And so what happens is mortgage rates are bonds or treasuries, and they're sold. They're like long-term, low-yield safe debts. So what happens is people invest in these bonds or these security instruments, and they invest in them for a year, 2 years, 3 years, 5 years, whatever it might be. Well, if the rate of return on that investment is lower than the rate of inflation, then that investment is losing money. You're better off investing in a different vehicle. So what happens is those people decide to stop buying these mortgage-backed securities and these bonds. So what they do is they raise the price of these bonds to be in line with inflation, so that way they can draw that money back in. And the way they provide these higher rates of return are higher interest rates on mortgages. So as inflation starts to come down, these companies that issue these bonds and the people that buy them, they offer them at lower prices. And that's in direct line. This isn't like an emotional thing, or it's a function. Interest rates are a function of inflation. And so everybody says, okay, well, the Fed's still raising rates. Yes, the last time the Fed raised rates, we saw an improvement in mortgage rates. So the Fed isn't triggering the interest rate market. The Fed is combating inflation. So by the Fed raising their rate, that brings the inflation down, which in turn brings mortgage rates down, right? So as we go through this year, yes, there are much brighter days ahead, and that's just going to be a function of inflation. And if you think about it, going super nerd mode, but if you take the last three CPI readings that we've had and you extrapolate those over a 12-month period, inflation would be growing at 1.6%, right?
Yeah.
So the government wants us at 2% or less. And the track that inflation has been growing, or like the rate of inflation over the last 90 days extrapolated over 12 months, is 1.6%. So we're there. The tools are working. It's just, it takes time. Like you're talking about percents of trillions, right? Of dollars. It just doesn't go that fast.
Yeah. No, it makes sense. And so I just think that for everybody that's in the housing industry, whether you're in the housing industry or you are a buyer or a seller, I think all of those parties looking ahead have things to look forward to, and one of those things is, I think everyone's question when it comes to the housing market, mortgage rates is driving demand, and we're going to come back to that in just a second, but everyone is saying, okay, with what is happening in the housing market, are we headed for a housing crash? The context around housing crash references property values. Well, the thing around values is that if you look at my screen right now, you haven't seen, all of this is in the green. There is no red, meaning this is all appreciation since 2012 coming out of the Great Recession. And all people are hearing or seeing is this huge, we'll call it a candle in the housing price market, went up by 20, 22, 23% as a result of the pandemic. We're just not seeing appreciation like we did in 2020, 2021. But, if we look over the course of year over year, I mean, we're still up as of December, 8.6%, and then the forecast is going to be pretty flat. So we haven't seen a huge decrease in home prices. We've seen a drop off in home sales, but I think what's going to happen is as mortgage rates continue to come down, more and more buyers get back in the marketplace, it'll drive this housing market once again.
And something to keep in mind on that that chart that you brought up with the green and the ski hills on it is that, it's important to note that where you're seeing it come down, that on the far right there, just to understand, that's not housing values. That's rates of appreciation.
That's
so
right.
We're talking about you're appreciating at 20%. So now we're appreciating at 6% or 4%.
Yeah, that's a great point.
That's not housing. That's not the housing values going down. That's the rate at which they go up, which is
Oh my
slowing
gosh,
down.
well said. It's so well articulated. And if you guys missed that, you should rewind that. This is the rate at which the home prices are increasing. So when you see a decrease in appreciation, that means that home prices are still going up. And so even this year, with everything that's happened, even with the sales of things dropping off, mortgage rates going up the way that they have, we still are predicting that home prices increase yet again, maybe by 2 or 3%, but nonetheless, they increase in value from where they were even in 2021. And so
which is what everybody was screaming for. When values are going up 20%, they're like, everybody was mad. They're like, these housing prices are going up so fast that we can't control it. And what's funny is the people that own their home, they're like, well, this is great. Like wait till your state equalized value comes out. They come and change the property taxes based on these. Like that rate of appreciation isn't good for anybody. You're talking at 20%, your house is going to double in value in every 4 years, which is completely insane.
Yeah. And of course, the thing that's driving the housing market is inventory, like we've been talking about for years. And so when we look at that, we have to say, okay, let's give this some more context. Yes, inventory's up. Yes, there are more active listings now than there have been this time last year, but we're still, between 3 and 4 months of inventory, which is simply, it's not even a buyer's market yet. We've got to get closer to 6 months worth of inventory to consider it a buyer's market. But right now, when we sit at 3.5, 4 months of inventory, we call this a neutral market. If you go back to the Great Recession, you can see that in order for home prices to drop, we've got to get, 8, 9 months worth of inventory, and we're just not even close to that.
Yeah. It's interesting because, you and I are always out here fighting the positive fight, right? Which makes way less money than the negative fight when it comes to getting people to pay attention. But that you have to understand that that is very good for anybody that's involved in 6 months worth of inventory. Anybody that's a real estate agent, a mortgage person, or a home inspector, or an appraiser, whatever it might be, that's good for you. That means there's variety. There's, you get your whether you're a seller or a buyer, it levels the market. There's more transactions that are going to take place with 6 months of inventory than there are with 3 months of inventory.
Yeah, and that's what I was saying earlier. There's a lot to look forward to as we get back into home buying season. There'll be a lot more opportunities. There'll be a lot more options. Rates will be more reasonable, and I think you'll find that it's a great market to sell real estate, to write mortgages, to buy a house, and to sell a house. That's why I've been saying this for so long, Steve, is I like normal markets. I'm not a huge proponent of extremes on either end. I don't like an extreme seller's market like we've come out of. It's unrealistic. It's very difficult for buyers. It wreaks havoc on the real estate agent industry. And so I like a normal neutral market where inventory is equal, the number of buyers and sellers is equal. And I don't like an extreme buyer's market where home prices are plummeting. I don't like that either. Who likes that? Yeah. So I like a normal appreciation, 3 to 5% a year, right? I like 4 or 5 months worth of inventory. And I like the fact that, you can negotiate with the seller and you've got something to choose from. And that from a real estate agent's perspective or a loan officer's perspective, it's a professional's market where you don't just do a weekend class and, show up and things are happening. This is really a market for experts. And so for all of those reasons is why I like where we're headed. Yeah,
I'm with you 100%. And part of that, and again, going back to it, is foreclosures, again, as much as that's scary, that's such a scary word because we're all, we're all so scarred still from 10 years ago, dude. Like the Great Recession was like 12 years ago, right?
Right.
2008, 9. Think about how long ago that was. Like that, like foreclosures are a really healthy part of the market. Like that would be like they would be welcome. That's how there's certain people that the only way they were able to get into a house was a foreclosure, and they put that sweat equity in and you build that house up. I mean, that's how you generate wealth in real estate. Like foreclosure market would be very, very welcome this day and age.
Well,
And there's just
yeah. So
not.
check this out. To your point, like lending standards and mortgage credit available, you can see to your point of like how we got out of control, right? Back in
Yeah.
2005, 2006, and just how things have come way back down to normal standards. And that also reflects foreclosures. We're not seeing the wave of foreclosures like we did before, which was a huge culprit in driving home prices down. We're not seeing that right now. So, I mean,
Yeah.
when you look at that, I don't know if you looked at the numbers lately. I could probably pull it up, the latest numbers from I can get it from Black Knight or whatever. But have you looked at foreclosure numbers as of January yet?
Yeah. It's still like less than 1% of homes mortgages are past 90 days late. I mean, it's up, right? It's up like 300% compared to last year, and those moratoriums were lifted. But overall, it's the credit markets have never been healthier as far as like on time payments. And from again, like being a guy that works in the industry, and I'm talking to clients and improving them every day. I can't tell you how often I talk to agents, and they're like, "Well, isn't like this person doesn't show enough income and this and that? Like, is there any way you can get them into a house?" And I'm like, let me talk to them. So I go over and, there's bank statement loans, things like that. And I talk to them about how much money they're making. I'm like, you don't make enough money to buy this house. Like that, regardless of what kind of loan you're getting, you don't make enough money to buy it. It's the
Mm,
bottom line.
yeah.
And there's not a secret trick for that anymore, you know?
Right. Right. So I think the next Fed meeting is in February, right?
Mm-hmm.
Yeah. So outside of that, is there any big indicators or big reports coming out that will continue to move interest rates? Because I think that's the thing, right? Is you've got everybody on the sideline. I mean, that's really what's happening in the market right now. Buyers aren't buying, sellers aren't selling. It's a stale. It's a market where no one's making any moves. I think the linchpin, if you will, is if we can get a nice dip in rates and get people off the sidelines, I think that will really help. Is there what can we look forward to? What big reports are coming up that might drive mortgage rates either way?
So the next one coming is going to be, we call PCE. So it's personal consumption expenditures. So that report does not. So the big thing that's really holding up inflation right now, or buoying, like providing the buoyancy for inflation, keeping it up, is shelter costs. So that's like leases, and the cost of home ownership makes up 39% of CPI, right? Which is the big one that we're talking about today. Well, PCE, which is personal consumption expenditures, which comes out toward the end of the month. I think it's in 2 weeks.
Hmm.
So that number has much less weight on that shelter cost. So that's one that the Fed really looks at when they talk about driving to that 2% rate. And so we're going to see that one come out, like I said, in 2 weeks. We're going to have the next Fed meeting, which we're looking at, and all the bets are on 0.25% increase, which is again staying on that lower trajectory as they look toward like 5%. So we're at 4.25 now. They're looking to have by the end of 2023 having the Fed funds rate at 5 or a little over. So we'll see some moderation. There's even a chance for a pause, which would be really welcomed in the interest rate world. And then beyond that, looking down the line, we talk about spring, and we keep going back to the shelter cost thing, and it doesn't matter what it is, right? Like we don't need to
Right.
go into the nitty gritty of it, but that's a number that's basically averaged over 12 months. And so if you look at the math and its current trajectory, that average is really going to kind of come over the hill in May. And so that's going to be, where we saw in November, and you and I were talking about it over the summer, like, look, we're going to replace some really, really high, we're going to replace really low inflation numbers with high ones. And so we're going to be changing those out, and it's going to look like inflation is going down finally. Well, that same thing is going to happen with this shelter cost, which should really drive that. So in May, which is going to be right at the beginning of buying season or summer sales season, we're going to see, I think we'll see a really nice rate. So we're going to be in a little bit of a roller coaster right now. It's all determined by like the vacillating markets, right? We're kind of trading in these channels based on what investors want to do. So PCE in the next 2 weeks, and then obviously we're going to have our Fed meetings and whatever's going on, and then we're going to see in May is going to be we're planning on that being a pretty big market mover to get us deep in the fives, like we're living in the five country.
I mean, that's great. And I think that's probably where we hang out for 2023 is probably, low, mid fives, somewhere in that range is kind of where we land. And I think that's a really healthy place to be.
Yeah, and look, I mean, there's a ton of you can dig in and get really deep in the weeds on surveys and things like that. But if you look at it, there's like probably 600,000 newly formed households that were in the housing market when rates went, and then as rates went up, they kind of pulled themselves back into the sidelines. Like those people are going to come back out. Like and even just like I said, being with boots on the ground type of thing. I mean, I've got a significant number of pre-approvals that are like just waiting. Now they're starting to see it. Like taking on a good amount of contracts for beginning of the year. So I think this summer. I think unless we find a trick to the inventory, it's going to be another busy summer.
It's great, man. Well, appreciate it. I mean, you drop so much good knowledge all the time. I do appreciate you coming on again and sharing
Thanks,
the
man.
wisdom. So we'll see you guys in another housing market update here very soon. But Steve, thank you so much.
All right, you got it, man.